Ever feel like investing is just, well, unnecessarily complicated? Trying to kick the winners, navigate all the noise, it's a lot.
Oh, definitely. Overwhelming is the word.
Right. What if there was I don't know, a common sense way through it all, a simpler path?
Well, that's exactly what we're digging into today.
Sounds good. What's our source?
We're looking at the little book of common sense investing by the legendary John C. Bogle.
Ah, Mr. Vanguard himself, the index fund pioneer.
That's him. Founded Vanguard, created the world's first index fund,
Yeah.
and he really championed this radically simple idea for building wealth.
And he wasn't exactly ignored, was he?
Not at all. You've got Nobel winners like Paul Samuelson calling the index fund like, the invention of the wheel for investing.
Wow. High praise.
And giants like Warren Buffett, Charles Schwab, they personally back Bogle's core philosophy. So our mission today is basically to pull out those key truths, the ones that make investing, well, less of a gamble.
Okay, let's get into it. What's the first big idea from Bogle? Where does he start?
He starts with something almost brutally simple. Costs. The undeniable math of low costs.
Right. He has that great story, the Gotrox family.
Exactly. The Gotrox family, imagine they own everything. All the businesses in the country. They get all the profits, the whole pie.
Makes sense.
But then these helpers show up. Brokers, managers, consultants. They convince some family members to start trading shares back and forth.
And these helpers need to get paid, I assume.
Precisely. Commissions, fees. Suddenly, the family's slice of their own pie starts shrinking.
Right.
More helpers get hired, maybe to pick stocks, maybe to pick the managers who pick stocks.
More layers, more costs.
Exactly. Advisory fees, high turnover in the portfolio generating taxes.
Yeah.
It all just chips away. Bogle called it the relentless rules of humble arithmetic.
Humble arithmetic. I like that. So if the market itself returns, say, 7%?
Right, but you're absolutely enormous. That's why Charles Schwab apparently asked, why would you screw it up when low-cost indexing is so predictable?
Why chase something with such long odds?
Yeah, the odds of an active fund beating an index fund over 15 years, they're vanishingly small. Like 1 in 223,000 small, according to some studies.
Wow. Okay, so keep costs low. That's critical. What's next? What else should we focus on, according to Bogle?
The next big thing is understanding the difference between what the market actually produces and how investors feel about it.
You mean like the business reality versus the market hype?
Sort of. Bogle breaks return into two parts. Investment return, that's dividends and actual earnings growth from the companies, the real
That's
stuff.
fundamentals.
And then there's speculative return. That comes from changes in how much people are willing to pay for those earnings, the price-to-earnings ratio. Investor sentiment, basically.
Ah, so that PE ratio can swing wildly based on fear or greed, right? Even if the company itself hasn't changed much.
Exactly. That's the noise. In the short term, speculative return can dominate. Makes the market seem chaotic.
Bogle uses that Shakespeare line, doesn't he?
Yeah.
About the tale told by an idiot full of sound and fury.
Signifying nothing. Yeah, it's a powerful image for that short-term speculative frenzy.
But over the long haul.
Over the long run, it's the investment return, the actual earnings and dividends that really drives your results. That's the weighing machine Benjamin Graham talked about.
So focus on the real business, not the market's mood swings. Makes sense. But ignoring that noise is hard. Which I guess leads to the third point.
It ties in perfectly. The third core truth is avoiding the trap of chasing past performance. This often comes down to something called reversion to the mean.
Meaning what went up must come down. Or at least come back to average.
Pretty much. Investors think they can pick the winning fund managers based on who did well last year or the last few years. But the evidence is just brutal. They're almost always wrong.
You mentioned some stats on that, like star ratings for funds.
Yeah, it's startling. One study showed only, 14% of five-star funds kept that top rating 10 years later. Half dropped to average or worse.
So finding a star manager who stays a star is like finding a needle in a haystack.
Basically, yes. It's like that sports team on an amazing winning streak. Eventually, luck runs out or things just average out. Funds are the same.
As Bogle puts it, the past is rarely prologue in fund performance.
He nailed it. High returns tend to fall back. Low returns tend to rise up towards the average. So picking based on recent success is really dangerous.
And the fund industry kind of encourages this, right? Promoting the latest hot fund.
Oh, absolutely. They play on those emotions. New funds often focused on whatever fad is hot. Bogle would say you're far better off just ignoring that noise and sticking with simple, low-cost index funds that capture the long-term economic growth.
Okay, so let's try to bring this all together for everyone listening. What are the big takeaways?
Well, first, the math on costs is undeniable. Keep them low with index funds, and you keep more of the market's return. That's job one.
Right. Second, focus on the real returns from businesses' dividends, earnings growth, not the emotional speculative noise of the market day to day.
And third, don't chase past winners. Performance reverts to the mean. Stick with your strategy.
So simplicity and patience seem key. Low costs, focus on the long term, ignore the fads.
It really comes down to that. Remember what Benjamin Graham said? In the short run, the stock market is a voting machine. But in the long run, it is a weighing machine.
Voting versus weighing. Love that.
So the challenge for you listening is this. In a world that's always pushing complex, expensive stuff, what's one simple change you could make right now? How could you align your investing more with Bogle's humble arithmetic and focus on that real market of business?